What is the Fed's role as lender of last resort? Imagine a sudden storm hitting a small town, and the only way to keep everyone safe is to have a reliable shelter ready. That's similar to what the Federal Reserve does during financial storms. The Federal Reserve, or the Fed, acts as the lender of last resort by offering emergency loans to banks that are temporarily short on cash. This helps prevent bank failures and keeps the entire financial system steady. When a bank faces a sudden rush of withdrawals and can't get enough money from other banks, the Fed steps in to lend money. These loans are usually secured with collateral, like government bonds or other assets, to make sure the Fed gets its money back. The idea is to give banks enough time to sort out their problems without causing panic. The concept of a lender of last resort goes back to the 1700s and 1800s, when economists like Henry Thornton and Walter Bagehot explained that central banks should protect the overall money supply, not just individual banks. They said that central banks should lend freely to solvent banks facing temporary liquidity issues, but only at penalty interest rates to discourage risky behavior. They also emphasized the importance of clear communication to avoid causing panic. Since the Fed was created in 1913, its role as a lender of last resort has grown, especially after the Great Depression. Back then, the Fed gained the authority to lend to banks through the discount window, which is a special facility for short-term loans. These loans are always collateralized, meaning the bank offers assets to secure the loan. During the financial crisis from 2007 to 2010, the Fed expanded its role even more. It created special programs to lend to a wider range of financial institutions and markets, like money market funds and companies that buy asset-backed commercial paper. These loans were also secured with collateral and repaid with interest, showing the cautious approach the Fed takes to risk. This function is vital because it helps prevent bank runs, where people rush to withdraw their money out of fear that the bank will collapse. When the Fed provides emergency funding, it reassures the public that the banking system is safe, and that the money supply won't suddenly shrink. In real life, if a bank suddenly can't meet withdrawal demands or can't borrow from other banks because of market chaos, the Fed can step in with emergency loans. This keeps the bank afloat and stops problems from spreading to other banks or the wider economy. Historically, before the Fed existed, private banks or clearinghouses tried to fill this role, but often with less success and more risk of a domino effect. The Fed made this function official and more reliable, adapting it over time to meet new financial challenges. In the end, the Fed's role as a lender of last resort is about keeping the banking system stable and preventing financial crises. It acts as a safety net, ensuring that solvent banks facing temporary problems can keep operating, which in turn protects the entire economy from collapse.